Understanding scenario analysis. Scenario analysis is a crucial financial tool that allows investors, businesses, and managers to estimate the expected value of a portfolio or decision outcome in response to specific changes in key factors over a designated time frame. This analytical technique is particularly valuable for understanding how various scenarios, whether likely or extreme, might affect financial performance. What is scenario analysis? At its core, scenario analysis involves forecasting the possible outcomes of an investment or business strategy by changing one or more factors, such as interest rates, market conditions, or even economic indicators. This controlled experimentation is akin to asking, what if, about various potential future states, enabling stakeholders to anticipate the effects of both favorable and unfavorable events. Key takeaways. Scenario analysis estimates a portfolio's future value following changes in key variables. It can simulate both common scenarios and extreme, unlikely worst-case events. The technique is useful in both investment strategies and corporate finance. How scenario analysis works. Methodology. Scenario analysis applies mathematical and statistical concepts to project shifts in portfolio value based on varying factors referred to as scenarios. This method often relies on what-if assessments, commonly known as sensitivity analysis. Sensitivity analysis measures how changes in an independent variable impact a dependent variable, providing insights into the level of risk associated with different investment opportunities. Steps involved. 1. Define scenarios. Identify the potential scenarios to analyze, ranging from typical market fluctuations to extreme events, e.g., economic recessions. 2. Input appropriate data. Use historical data and market forecasts to inform your scenarios. 3. Run simulations. Employ statistical tools or computer simulations to assess how changes to your input variables will affect your investment's value. 4. Interpret findings. Analyze the results to understand the potential risks and returns associated with each scenario. Example of scenario analysis: stress testing. One specific application of scenario analysis is stress testing, which is frequently employed by financial institutions. Stress tests simulate extreme financial conditions, such as an economic downturn or interest rate spikes, to evaluate an institution's resilience and risk exposure. Regulatory bodies have increasingly mandated such tests to ensure banks and financial firms maintain adequate capital ratios to withstand potential crises. Scenario analysis in different situations. 1. In investment strategy. For investors, scenario analysis may involve assessing the potential value of a portfolio based on a range of market returns. Analysts might calculate expected outcomes based on security returns that vary several standard deviations from the mean. This enables investors to plan for both positive and negative extremes. 2. In personal finance. Individuals can apply scenario analysis to various life decisions, such as buying a home, investing in education, or taking a new job. For instance, an individual could evaluate the financial implications of financing a car versus saving for a cash purchase, or assess salary changes against additional commute costs when comparing job offers. 3. In corporate finance. In the corporate context, businesses use scenario analysis to evaluate decisions around product launches, market expansions, or resource allocations. For example, a company might analyze how different locations for a new store could impact profitability based on differences in rent, foot traffic, and demographic factors. Advantages of scenario analysis. Comprehensive exploration. Scenario analysis allows for an in-depth examination of a wide range of potential outcomes. Risk identification. Businesses can identify potential risks and their impact on strategic goals before implementation. Decision-making framework. It provides a structured approach to assess the implications of different strategic choices. Disadvantages of scenario analysis. Dependence on assumptions. the accuracy of scenario analysis hinges on the quality of inputs and assumptions. Poor inputs can yield misleading results. Potential bias: analysts may bring personal biases to the scenarios they choose or the data they consider. Data-intensive, reliable scenario analysis often demands significant historical data and computational resources. Scenario analysis in risk management. Within risk management, scenario analysis is crucial for identifying and preparing for a range of potential outcomes, including negative shifts in the market. By analyzing downside scenarios, risk managers can develop strategies to mitigate risks. Scenario analysis in strategic management. In strategic management, scenario analysis is used to test various business strategies. For example, a company might simulate the impact of acquiring a competitor or launching a new product under varying market conditions to gauge potential success. Scenario analysis versus sensitivity analysis. While both tools are used for risk assessment, they differ in scope. Scenario analysis evaluates multiple variables simultaneously to generate distinct extreme outcomes, base case, best case, worst case scenarios. In contrast, sensitivity analysis investigates the effect of changing one variable at a time, helping to isolate the impact of that particular change. Conclusion. Scenario analysis serves as a vital tool across investment, personal finance, and corporate decision-making. By effectively modeling various future scenarios, it provides a clearer understanding of risks and potential returns. However, its utility is intrinsically linked to the accuracy of the inputs and assumptions fed into the analysis. For investors and managers alike, harnessing scenario analysis can significantly enhance decision-making and strategic planning.